Welcome back to another video. Sohail here, and today I want to talk about ICT trading, or the other name smart money concept method of trading. This is a complete beginner's guide and we're going to explore the basic concepts of the ICT methodology so you can understand how this method works and how you can use it in your trading. Without wasting any more time, let's get started. ICT is an abbreviation of Inner Circle Trading. A famous trader named Michael Huddleston owns and operates the Inner Circle Trading. Michael is the author and creator of smart money concept method of trading. This trading technique is purely based on price action and no indicator is used at all. This method focuses on tracking smart money, the money that has flown in the market by institutional and large traders, because Michael believes that these are the market movers, and indeed this is true. When institutional traders, hedge funds, banks or other large traders, when they enter in the market, their huge capital moves the market. So if you want to be part of that move, you need to know when the smart money is active in the market. There are many concepts in this method of trading, but there are some key and basic concepts that you must understand if you want to use this method of trading, and in this video I'm going to cover them. The first one is liquidity, and it's the most important concept in ICT trading, and you must completely understand it. We have two types of liquidity: buy-side liquidity and sell-side liquidity. Buy-side liquidity is the area of the chart where traders who enter a short position, they place their stop losses in this area, and on the other hand, sell-side liquidity is the area of the chart where long position traders will place their stop losses. These areas are usually near top or bottom at extreme levels, and these are actually areas where traders view it as being wrong if the price reaches to that area. So that's why they place their stop losses there and want to exit their positions in that area. For example, a trader who enters a short position here near this top level, he or she will place the stop loss in this area because they believe that if they are wrong, the price will break this level, so they consider this area for exiting their position. They are entering a short position and their stop order is a buy order, so there are lots of buy orders already placed here in this area. That's why it's called buy side liquidity. It means that in this area we have already liquidity for buy orders. On the other hand, a trader who enters a long position here near this bottom level, he or she will place the stop loss in this area below the bottom, because similarly they believe that if they are wrong, the price will break this level, so they consider this area for exiting their long positions, and for exiting their long positions they need to place a sell order. So there are lots of sell orders are already placed here, and that is why it's called sell side liquidity, meaning in this area we have already liquidity for sell orders. Institutional and large traders take advantage of the liquidity of these areas and they enter a long or short position near these levels, which many stop losses are already placed. Actually, it's because of the large amount of stop losses in these areas that these large players can fully realize their positions. When these areas are traded, most of the time the price will reverse and head to the opposite direction, seeking liquidity at the other side. The next concept is displacement. Displacement is very strong movement of the price which creates strong buying or selling pressure. Displacement can be a single candle or it can be a group of candles, like 2 candles or 3 candles, which all of them are in the same direction. I mean all of them are red or green, and basically they are a strong candle, which means they have large body and very short shadows. This formation tells us that there is a complete disagreement between buyers and sellers, and one side has the control. Most of the time, displacement happens after a liquidity level was broken, and they usually causes fair value gaps or market structure shift, which I'll explain them later. The next concept that you must understand is market structure shift, or traders call it MSS for short. As you know, the market has a structure. It's either trending or not trending. When it's trending up or it's trending down. When the market is in an uptrend, the price is making higher highs and higher lows. And when the market is in a downtrend, the price is making lower highs and lower lows. These are definition of trends and the basic concept for identifying trends and drawing trend lines. When the market is trending, if the trend is broken, a market structure shift happened. For example, when the market is in an uptrend, the market structure shift is where the previous low is broken and a lower low is made on the chart. And if the market is in a downtrend, the market structure shift is at the level where the previous lower high is broken and a higher high is created on the chart. So when a market structure shift happens on the chart, it's a good opportunity for us to look for more signals that the trend is real drastically changed, so we can enter in that trend in the early stages of developing. In cases that we have a strong and instant reversal, the market structure shift is in the form of displacement, which I explained it earlier. The next concept is break of structure. As I explained previously, when the market is trending, it's either trending up or down. When the price is trending down, we have lower highs and lower lows, and each of these lower lows create demand zone during the pullbacks. This means when the price reaches to this zone, we expect increasing of demand and probably advancing of the price, and when it's broken, it's break of structure, and it can be used as a confirmation for trade entry in the direction of downtrend. And when the price is in an uptrend, the price is making higher highs and higher lows. Each high makes a supply zone during the pullbacks, which means when the price reaches to the supply zone, we expect increasing of supply and so declining of the price. And when the supply zone is broken, it shows that probably the price is going to advance more, and it can be used for confirmation of trade entries. If you don't know what supply and demand zones are, I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it because supply and demand are the most basic concepts that every trader should understand. The next concept that you must understand is fair value gap. As I explained earlier, when the price reaches to liquidity levels and after that we have reverse of the price, usually we have displacement, and inside the displacement, fair value gaps are created and they show inefficiencies or imbalances in the market. These imbalances are created on the chart in the form of a 3 candles pattern, which the middle one is a large candle, and for the other 2 bordering candles, their lower shadow and upper shadow should not overlap, and also better not to have overlap of the body of the middle candle with the other 2. Fair value gaps act like a magnet for the future price action, so they can act like supply and demand zone. The next concept is balanced price range, which is formed when we have an aggressive advancing of the price in the form of a long green candle with very small shadows or no shadows in the ideal situation, and then instantly we have an aggressive declining of the price which closes below the previous candle. Similar to fair value gaps, this area is acting like a magnet for the price, and we have retest and reject from these areas. Balanced price range also sometimes signal the beginning of market structure shift. The next concept is optimal trade entry. As the name is indicating, this concept helps you in identifying the best place to enter a trade, and Fibonacci retracement levels are also used in this concept. After having a market structure shift and formation of a new leg of price action, having a pullback can provide us a great opportunity for entering a trade in this new trend. In this step, Fibonacci retracement levels can be used for identifying end of the pullback. The optimal trade entry is somewhere between 61.8% and 78.6%. If you're not familiar with Fibonacci retracement levels and how to draw them, I have a complete guide on this. The link is also placed in the description, and I recommend you to watch it so you can learn how to use it in your trading strategies. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.